It is just a fact of life that if the government wants to borrow to deliver its agenda, it will need to find a place where the market and investors are willing to lend to it. And if you want to do all of these things in kind of the real economy, if you want to be able to build schools and build infrastructure and, have policies that provide a welfare state, unless you want to do all of that from immediate taxation, you're going to have to go to the market and ask to borrow, and you're going to have to agree terms with the market.
Hello and welcome to the IFS Zooms In. I'm Helen Miller, Director of the Institute for Fiscal Studies. Are we in hock to the bond market? Is it Rachel Reeves or market investors who are dictating the stance of fiscal policy? Why is fiscal credibility so valuable, and how do chancellors make sure they hang on to it? These are just some of the questions that we'll tackle today in this episode on bond markets. Along the way, we'll look at how the government borrows, how much it costs to borrow, and at why it is particularly expensive to borrow at this moment in time. This is important stuff. The nation's interest bill currently runs over £100 billion per year. If there were a department for servicing the national debt, it would be the second biggest department outside of the National Health Service. The bond market, really meaning the investors who lend to the government, will be watching the upcoming budget closely. The Chancellor will be keen to see their reaction. Today we'll ask what they are all looking for. And in doing that, we'll be drawing on work from the IFS Green Budget, which this year was funded by the Nuffield Foundation and by Barclays. And joining me to talk about all things bond market and the budget are Jack Meaning, who is the Chief Economist at Barclays, and our very own Ben Zaranko, who leads our work on public finances. Welcome to you both. So as ever, I think we should start with some basics before we get dragged into the weeds. I mean, in short, the government borrows money by issuing government bonds, which perhaps confusingly they call gilts. Investors buy those bonds and the government therefore gets money. But let's unpack that. Ben, what is a government bond?
I think the simplest way is to think about it as an IOU. It's a financial instrument, but it's basically a way of saying the government says, you give me this much money today, which I can then go and use to spend on nice things the government wants to do. And in return, I promise to pay you a stream of interest payments until the point when the bond is redeemed, and in which point you get your cash back in full. I think that's about as simple as I can describe it.
That sounds pretty good. And they're called gilts, I think, because the initial paper-based version of this had little golden edges.
Gilt-edged securities, yeah, so they're called gilts.
Gilts. And Jack, we should explain to people prices and yields.
Yeah, these are two really important concepts that pull in the opposite direction. So the price is essentially, if I come to you and say, I want to borrow something that will pay you back £100, how much will you give me in return? So that could be £100 if I'm completely trustworthy. It could be less than that if I think there's risks involved. So that's the price that you pay for the bond. And then the yield is basically the interest payment that you get across the life of holding that bond. So that might be 5%, that might be 2%. And importantly, as the price goes up, the yield goes down because you're paying more for the same amount. So those interest payments you get as a percentage are less.
Okay, Jack, so let's just walk through for people a really simple example of how these bonds and prices and yields are working.
Okay, so let's assume, Helen, that I want £100 to be able to do something in the economy. I want to buy something nice or build something nice. So then I ask you to give me that £100 and I say, I will pay you on the £100, 5% interest each year. So at the end of the year, you'll get £105. Now, what price will you give me to be able to give you that piece of paper that says I'll pay you £105 in a year? Now, if I'm completely trustworthy and you're happy with a 5% return, you might just give me £100. But it might be that you think there's some risk, that you don't think I'm very trustworthy. So you might say, well, actually, I'll only give you 90. And that 90 is the kind of the cash that I get. Then the interest rate is basically the amount that I get, the difference between the £105 that I've got to pay you in the end versus the £90 that you give me. And that basically gives us our interest rate.
Yeah. So from my point of view, in example, if I'm the person lending you the money, I'm the investor, then the price is how much I'm willing to give you today. And the interest rate is how much I get back in future.
Exactly.
And from my point of view, I want a low price, but you want a high price. And the higher the price, the lower the interest rate would effectively be.
Exactly that.
And from the government point of view, when they're selling this debt, they want a high price. They want to sell the debt at a high price so they get lots of money into the treasury.
Exactly. So that means the £100 IOU that Ben mentioned that you're selling, you might get £120 for that. And then, you've got more money for the same amount of obligation in the future.
And then very briefly, Ben, In terms of how the auctions for these things work, talk us through briefly what's the government doing when it wants to get money?
Well, the government, via the Debt Management Office, has effectively a target of how much money it wants to raise each year and issues guidance on that. And then every so often, periodically, it'll have auctions where effectively it says, here's how much I want to borrow. People in the market, effectively bid and say how much they're willing to pay for that, or conversely, what sort of yield they'd be willing to accept for that. And then government borrows that way. And in general, its auctions are what's called well covered, which basically means for every £1 the government wants to borrow, there's people who are willing to lend it that several times over. It's not struggling to find people from whom to borrow. But the point is that the price at which it pays is what's the sensitive thing here. And I think that we can pretty much always find someone to lend us money, but we don't know that it's always going to be at a price we'll be happy with.
And Jack, give us the potted history. We're borrowing quite a lot of money at the moment. We're borrowing more than recently. What do those kind of sums look like?
Yeah, so I mean, I think we saw a big uptick in the amount we needed to borrow through the pandemic a few years ago, and it's remained high. So if I think about just the private sector, so not what is held by the Bank of England, which has been an important consideration recently, but if I think about what's being held by the private sector, they are being asked to absorb roughly 4% of GDP at the moment. That will rise to around 6% over the coming years. But historically, that was only 2.5%. So we're asking the private sector, so investors in financial markets, to absorb a lot more borrowing, to lend a lot more net to the government relative to the size of the economy than they have done for a long time.
It's where I think it's useful here to bring in, two real workhorse economic concepts. Anyone who's taken even the starter class in economics will be familiar with supply and demand. But I think that's really at the heart of this, right? It's a question of the supply of government bonds, which is largely, but there's a bit of complications here, but it's largely determined by how much the government wants to borrow. And that's what Jack's getting at there, is we're borrowing more, and the supply is being pushed up even further by the fact that the Bank of England is also selling bonds at the same time as the government is. And then there's the demand question of who's willing to buy those bonds and at what price. And it's really the interaction of those two things which determine a lot of the dynamics that are at play here.
And we should just fill in to listeners, the Bank of England isn't issuing new government bonds here. They are they're selling now bonds on the secondary market. So a government at some point has sold debt, got money into the Treasury, but now the Bank of England on that secondary market historically was buying up government debt, and now it's selling government debt.
Exactly. And why that matters is because if you're a private sector investor, you now have the option to go and buy the debt directly from the government as it's issuing it, or you can buy it from the Bank of England. So actually the amount of supply that you've got offered to you is greater on both dimensions now.
So I think it's worth just spelling out that ever so slightly. So there's the primary market, in effect, is the government issues a bond and you buy directly. But these things also trade secondhand, and people who might want to hold fewer bonds than they did previously, or maybe buy more, they can sell them to each other directly without the government being involved, right? So it's the equivalent of maybe you've bought your car direct from the factory, but now you're selling it to someone else down your street. But both matter when we're thinking about how much the car's worth.
And actually, when we're filling in this picture, so you have the UK government issuing new bonds, new gilts. You have the Bank of England selling bonds it had previously bought. But I think I'm right in saying, Jack, that other governments are also doing more selling of their bonds. There's just more governments around the world are trying to borrow more money.
Exactly. So, we work in an open and kind of international economy. And actually, this is not a UK specific thing. Lots of governments have increased their borrowing either because of the pandemic or because they need it to boost growth in their economies. And obviously, if you're an investor sitting in London or sitting in New York, you're able to choose across those different kind of countries and economies where you think actually you'll get the best return. So you have to be competitive globally as well as just within your own country.
So let's talk a bit more about who's buying the government bonds. So Ben, one thing you and I have discussed on other podcasts is about the changing role of defined benefit pension schemes. So maybe let's just define what those are and then why their role is changing.
So more commonly referred to, I suppose, as final salary pension schemes, though they're not always actually based on your final salary. It's where you often, very common in the private sector, now basically only really a thing in the public sector, where instead of just having a pot of money that was your pension that you can do with what you want, effectively your pension comes in the form of a promise that will pay you this much money every year until you die. And importantly, these defined benefit, the benefit is defined, that's why it's called defined benefit pension fund, and they importantly held large amounts of assets in order to pay for those future pension payments, for those liabilities that they held. And they used to be an enormously important buyer of government debt, partly because it's denominated in the right currency. If you're paying your pensions in sterling, you want to hold assets that are also in sterling. You could buy government bonds that get you some inflation protection. Very handy if you've also got to pay out pensions that are directly linked to inflation. And so they were a big part of the system, and particularly buying longer term government debt. So like a 30-year IOU rather than a 5-year IOU. That matters as well. But they've just become less important over time as private sector companies have wound up those schemes and shifted more to what's called defined contribution pensions. And as those schemes have shrunk over time, as their members have increasingly died and stopped claiming their pensions. And so they're just less of a significant buyer than they used to be. And I think that's really reshaping the demand side of the market for government debt.
So, Jack, now we basically have more international buyers of the UK government debt.
Exactly that. And those international buyers are more sensitive to the price because, like we were saying earlier, they've got options across the world. And so, if the UK becomes relatively more attractive, then their demand will go up and they'll move their funds into the UK. But similarly, if it goes the other way, they're just as easily able to move across. So the big difference between the defined benefit pension schemes that Ben was just talking about and where we are now is we have a group of investors who still want to hold UK assets, but are much more price sensitive and much more discerning in terms of where they put their money. So that brings with it a risk of having to at times pay up, but also a premium for being a stable, attractive economy.
So you put that sort of supply and demand together, then you've got the UK government trying to borrow more money at the same time that other governments are trying to borrow more money. You have a change in the buyers of government debt, in the investors. That's basically making it a more expensive time to borrow money. The government has to pay out more on those bonds to get money into the door. Before we put together what that means for this particular budget, we should back up a little bit. I mean, most people would have been blissfully unaware of the bond market before Liz Truss rocked up. It just wasn't something we really talked about. Then Liz Truss turned up as Prime Minister and everything changed. So maybe, Jack, talk us through what happened in the Liz Truss moment that made everyone suddenly aware of the bond market.
Yeah, I mean, I think, look, this is one of the things where people that do my job and live in my world, we live in the weeds of the bond market, but actually you don't want it on the front page of the BBC website that, something's going wrong. That's a bad sign. What we saw in 2022 was actually a budget where the Chancellor and the Prime Minister had made a commitment to cut taxes relatively significantly, but they removed some of the guardrails. So normally the Office for Budget Responsibility would be the adjudicator on fiscal rules, and they would do an assessment of any policy packages. That didn't happen at that budget. A decision was taken not to let them do a forecast update. And so people were less clear about exactly how these tax cuts would be funded. And so they started to feel the UK was a bit more risky than otherwise. That caused an increase in yields, a fall in the price of bonds. And then because of the nature of the investor base, we had lots of liability-driven investors. They were people who kind of tried to match what they had on the asset side of their balance sheet with the liability side. They then started getting called for cash. So they had to basically sell assets, sell gilts in order to be able to fund what they needed to. That then created a cycle. So essentially what we got was the more they sold, the more the price dropped, which meant they needed to sell more. And that cycle continued until actually we ended up with yields significantly higher and the price of bonds significantly lower.
Just to put out two things you said there. I mean, one is just that Liz Truss announced new policies, so new tax cuts. But even conditional on whatever tax cuts she might have wanted to put through, there was that point about the kind of the trust in the institutions and who is checking the homework. I mean, how important do you think were those two relative things? One is just the unfunded tax cuts. Maybe investors worry that the government won't be able to pay for that in future, versus just the institutional structure and the trust that someone else is checking what's happening.
I mean, I think we've seen relatively big swings in kind of government positions in terms of policy across multiple decades now in the UK. And if the institutions are in place, if people have confidence, then actually you can make those adjustments. I think what we've seen is that actually institutions are paramount at this point. People need faith. Think of any type of borrowing, you need to trust the person you're lending to. And so anything that shakes that, particularly saying, I don't want my homework marked, it might raise the question of, well, why don't you want your homework marked? Is it that it's pretty poor standard? And so, I think the institutions were absolutely paramount there.
I think there's two extra really important things about the mini budget episode as well. I agree with everything Jack said. I think two other things. One is the context in which it happened when the UK was going through effectively double-digit inflation at the time, or certainly close to double digits. And there was a sense that was because of constraints on supply, energy price shocks. It wasn't because of anything else. And doing a big 40, 50 billion package of tax cuts, putting money into the economy, into people's pockets at that time was expected to fuel inflation further. And therefore, everyone expected it would lead to much higher interest rates at the Bank of England than otherwise. I think that's a really important part. The inflation context matters. And the other thing that I think is underappreciated is it's quite normal for bond yields to they sometimes move around quite a lot and they can see big changes. But to see that larger change in that shorter period, I think is what drove the market into some of those like really destructive cycles, right? It was almost the speed of the change as much as the size of the change that caused problems. Because actually, bond yields now they've come down a little bit in recent weeks, but they've been even higher than during the mini budget episode. But they got there through a slow climb. If you do that climb all in the space of one day, that's when you start to get weird stuff going on in the market.
We'll come back to the kind of here and now in a minute, but I mean, the question that we have all been asked, but I'll ask you first, Ben, is to what extent are we still paying the price today of that specific mini budget episode, do you think?
Well, first thing, I think I don't like the line that, Liz Truss crashed the economy, right? I think that's a misnomer. I think this stuff does have real economic consequences, right? Like a big spike in borrowing costs for government not only squeezes what government can do, it also feeds through into higher mortgage costs and squeezes household spending, or it affects the rate at which firms can borrow money. So it does matter for the real economy. But we didn't suffer like a gigantic recession in the second half of 2022. If anything, Liz Truss wasn't in power long enough to deliver a recession. And I think that this stuff does matter, but it's sometimes overblown for political reasons. I do think, though, that the UK, if you look at where our borrowing costs have been relative to other countries, there is, Jack will have a much better idea of this than me, but it looks like there's some sort of lingering sense that the UK lost something in its reputation for credibility and for trustworthiness at that point that maybe has lingered a bit. Looks like maybe we're facing slightly higher costs. Some international investors have got a little bit spooked out by the UK's policymaking processes, but I think it's quite hard to nail down with certainty. But it certainly seems to me there's been some lasting effect there that we're now having to maybe show, not tell, to a greater extent than we used to, actually having to prove through action, not words, when previously maybe would have got away with just some strong words.
When you were saying, Jack, you have all these international investors now who are shopping around and deciding which government's debt to buy. Do you think there's some truth in that people are a bit more nervous than they would otherwise have been had the Liz Truss episode not happened?
Absolutely. So I've just come back from New York to see a whole load of international investors, and I would say without fail, in every meeting I was in, they mentioned 2022. They mentioned the gilt market trouble we had then. And I think, it's hard, as Ben says, to put a number on it, but it absolutely is in the back of people's minds. And I think that has just meant that has shifted through the UK's dynamics. The bar is a little bit higher to convince people now than it was previously. So, Ben's absolutely right. Partly because of the kind of fantastic actions of some of my kind of ex-colleagues at the Bank of England, the market turmoil was relatively short-lived. And so we saw that kind of get back to more normal levels pretty quickly, and it didn't morph into something more dangerous. But actually that kind of psychological scarring, I think, is absolutely still there.
Okay, so let's move to look at the kind of what it means for this budget that's going to be in a few weeks' time. We already said that government is borrowing quite a lot of money, but it's expensive time to borrow. Again, the question that all three of us would have been asked lots of times recently is the UK in hock to the bond market? What do you think, Jack? What's your answer?
I just find the phrase very, very difficult to kind of get my head around, because you're not in hock. If you want to borrow something from somebody, you have to agree terms on that, right? And Ben said earlier, you will always find someone that's willing to lend to you, but you will have to find a price that's acceptable to both of you to do it. And so, it is just a fact of life that if the government wants to borrow to deliver its agenda, it will need to find a place where the market and investors are willing to lend to it. And if you want to do all of these things in kind of the real economy, if you want to be able to build schools and build infrastructure and, have policies that provide a welfare state, unless you want to do all of that from immediate taxation, you're going to have to go to the market and ask to borrow, and you're going to have to agree terms with the market on that. So I don't think it's a case of in hock the bond market is, bullying the government over the head. It's a mutual agreement. We want to do this. We need this from you. what are the terms we can get for it?
The Chancellor's going to want to make sure, Ben, that whatever she announces doesn't give her a premium on that borrowing cost, right? She's going to want to keep the cost of borrowing as low as possible because it's expensive.
Right. And I think we're clearly worrying about, or the government certainly is worrying about the reaction of bond market investors more than it used to. Now, partly that's a post-Liz Truss, post-2022 feature. I think in part it's just the fact that interest rates and government bond yields are higher now than in the past. They're a bit more volatile now than in the past. And when you combine that with a world where we are meeting our fiscal rules by very fine margins, meaning that even fairly modest movements in bond markets can be enough to put the government on track to miss its rules. You've got a sort of a cottage industry of people who now seem to market these moves in yields and plug it in and say, oh, what does that mean for headroom and so on. We're clearly worrying about it more than in the past, but that's just a function of wanting to borrow lots of money in circumstances that aren't particularly nice, and it's not a good time to be borrowing. So we just have to deal with the reality of that. But I think that it's clear that one way in which this budget will be judged, I think, is by the market reaction, not just on the day, but in the following days and months. But clearly that's going to be part of Rachel Reeves' consideration for sure.
Before we come on to that, I mean, I think you've got a nice number in your back pocket, Jack, about how much even small change in yields matter for the government finances. So even a small difference in what kind of the interest rate the government has to give has a pretty big effect on how much the government has to raise.
Yeah, so if you move the average gilt yield, so the average government bond yield by just 0.5%, which can happen in markets over a relatively short period of time, that broadly cost the Chancellor about £7 billion in terms of her headroom. So, that's not a small amount, roughly kind of 0.2% of GDP, which again, that's, money that isn't going into schools, isn't going into kind of hospitals and roads and things. And it can happen very quickly in the market at the moment.
So they can come down as well as go up, right? Actually, if you look at recent weeks and months, particularly on 10-year yields, I think have come down really quite noticeably.
I mean, so the swing the Chancellor has had, so we took a snapshot about a month ago to work through, I mean, we are part of that cottage industry, Ben, of people working out headroom.
No, sorry, Jack.
No, I'd prefer to be doing other things with my time. But we took that snapshot a month ago, and there was additional cost from the last forecast the Office for Budget Responsibility did of about £5 billion. The market swinging just in the last month means that has switched to a £2 billion benefit relative to where she was. So £7 billion has moved to the Exchequer just from the government bond market having a more favourable view of the Chancellor and her plans.
Which has the bizarre consequence of meaning that the precise window which the OBR use to condition their forecast upon could matter quite a lot. If they'd close it 1 week earlier or one week later, that could be matter to the tune of billions, which is the fact that UK fiscal policy then seems to respond to decisions like that is an oddity in and of itself.
We said that the bond market, which really means investors will be looking closely at the budget, like we will, and the Chancellor's looking at their response to the budget. So let's walk through, what is it investors really, what do they care about? What is it they're going to be looking at? And I suspect the answer, Jack, is they don't care about the precise fine-tuning of tax policy as much as we might care about that. Like when they see the budget document, the budget speech, what's the big thing they're looking at that's going to determine the price at which they're willing to lend to the government?
I mean, so I think the more cynical traders that we have on our trading floor would say they flick straight to the number that says how many gilts do you want to sell? And if that's a bigger number than they were expecting, then it's a bad budget. And if it's a smaller number, then that's a good budget.
So it's about supply and demand.
Exactly, about supply and demand. I would say it's probably more nuanced. In fact, it almost certainly is more nuanced than that when you kind of get beyond the initial few minutes reaction. So, what you will want to see is really something where there is a plan, that there seems to be a credible way in which not only are we going to borrow this money, but we're going to have a plan to grow the economy and be able to pay it back. And I think that is the type of thing that actually, the market will be very receptive to.
And I assume on the borrowing, it's also the credibility that people believe that you're going to borrow what you say you're going to borrow. So the main fiscal rule that Rachel Reeves has is basically saying that in 3, 4, 5 years' time, she wants revenues to be covering day-to-day spending. So you need to be confident enough in her plans for spending and revenues to think that she's going to pull that off and get enough revenue in to cover that spending. So if she announced a tax rise that people didn't actually think she was going to follow through with, or that might not raise as much revenue as she hoped, you might worry that she'd borrow more than she said she was going to borrow. And that in the supply and demand sense is going to worry your friends in the market?
Yeah, I mean, I think that works on two dimensions as well, because it may be that, and this is the tightrope the Chancellor's walking, is it may be that in trying to get the revenue that she needs to be able to make sure she can pay things back, if she slows growth sufficiently, then she'll lose other streams of revenue, and the market will kind of say, well, you slow the economy too much, you won't have anybody left to tax, and we won't be able to, you won't be able to pay us back. But similarly, you don't want to have any taxation, because then you're not raising any revenue. So I think it's that, how do you manage to keep growth going and keep the market convinced you can keep growth going, whilst also finding enough revenue sources that you can kind of get back what you need to pay back what you owe.
Ultimately, if you're an owner of government bonds, what you want to see is less supply in future, right? Because the more supply there is, the more it pushes down the price of the asset you're interested in. So if I think the way I often think about it is, it really comes back to the fundamentals of, yes, what Jack says, how many gilts does the government planning to issue this year? That clearly matters. But then the projected path for borrowing and for gilt issuance in future years, A, where is that path going? But B, do you believe in it? Because if you think that actually there's no way the government will be able to stick to those spending plans, or there's no way the government will get all those tax rises through Parliament or whatever, maybe you then think, actually, I suspect the supply of bonds, the amount of borrowing will be higher in future, and I'm going to price that in accordingly. So it's not just about the numbers you present in the budget, it's about whether they're viewed as credible and about whether you can convince people that you mean what you say. I think that matters just as much as what you actually say.
And just put up on that, I mean, Jack, how much of it really is about, as Ben would say, the fundamentals? So investors will look at the underlying, what are the policies, they'll come to a judgment on how do they think that affects growth, they'll put it into models, that kind of what they think is really going to happen, versus more of the political narrative and the discussion. And do they hear a story they understand? Do they believe in the broader narrative? What's the role of those different things?
I mean, they both exist, right? You have a whole range. No investors are exactly the same. So some will be, kind of paying kind of not that close attention to the markets at all points in time, and they may be more inclined to kind of go for the vibes. They will want to see something that feels about right, that they think has a good story behind it. But actually, there are a lot of people, and there are often very important investors in the market, who will crunch the numbers. I mean, a case in point is in the budget last autumn. We saw the initial numbers come out. People thought, actually, these numbers are relatively good on the first implication. And then people crunched through and said, oh, hang on, this is going to push inflation up. That's maybe going to mean the Bank of England can't cut interest rates as quickly as we thought they could. That might be a problem. And actually, there was a slightly delayed reaction as people crunched through what they thought were those fundamentals. So they both matter, but actually, ultimately, you need to get the fundamentals right.
I think it's another really important thing there, which is on the day, what might matter most, at least in the initial first few hours or so after the Chancellor sits down, is how it compares to expectations, right? Because a lot of this has been priced in. I mean, God knows there's been enough bloody budget speculation this year, over this summer. So a lot of the stuff, the Chancellor gave a slightly content-light speech last week. There's been lots of stories in the newspapers that decisions have been made. Some stuff will be priced in, right? So then on the day, it almost is this about what we were expecting? Is this different to what we were expecting? Is there any nasty surprises buried in there that will matter just as much? And I think tell me if I'm wrong here, Jack, but I think there's something weird about the timing of Thanksgiving this year and how it relates to the budget. So does that mean there's going to be loads of US investors just doing it really quickly so they can go off and have big turkey with their families? Is that the idea here, that it might be a very compressed initial window in which the budget's analysed?
Yeah, I mean, I think that's true. The timing with Thanksgiving is difficult, because I think there will be a lot of people who've got half their mind on the turkey rather than on financial markets. But yeah, I mean, I think this kind of immediate reaction versus kind of then what plays forward is absolutely crucial, because the headlines will be one thing and the kind of political fallout will be one thing, but actually kind of more long term, what you really need is the investor base on side.
And when we're talking about what's priced in, we're talking about things like how big the markets expect the kind of OBR downgrade of productivity to be. So how much work does Rachel Reeves have to do to get back to not meeting her fiscal rules? Is she going to build herself more headroom against those fiscal rules? I think most people expect that mostly it will be through tax rises that she does that fiscal consolidation, but also which tax rise. Will she go for a couple of big ones or lots of little ones? So it's relative to those expectations people will be looking at and saying, is it in line with what I expected, in which case not much will move? Or is there a surprise there in terms of how bad the downgrade was, or how big the change in headroom was or wasn't, or what the tax? It's those kinds of things that people are going to be looking for to see is it what I expected?
Yeah, and I mean, actually, this budget more than any, I think, has got a really interesting dynamic there, because I think what we've seen, and Ben talked about, the fact that we've had a lot of briefing, probably more than we've had before any budget from kind of official sources. But that has been very beneficial to the Chancellor. That's broadly what's driven that kind of £7 billion swing in her headroom that I was talking about from yields coming down, is because the market has heard what she's been saying and thought, we could quite like the sound of this. So, the fact that this is going to bring down inflation, that's an aim of the budget. The fact that she will make tough choices, the market likes that because it shows she's serious. And she's reaped the benefits in terms of lower interest rates and lower yields. The difficulty is, and this comes to the expectations point, is then you have to deliver that, or else actually the market reaction goes back the other way and can move pretty quickly. So, you can get the benefit in advance, but then you kind of have to follow through, or else the market will just snap back.
We should make sure we pull all this back to real stuff as well. We're talking abstractly about markets and borrowing and stuff, but for people listening out there who don't really care about borrowing per se, they care about living standards or their lives. All this stuff we're talking about matters for the size of the economy and what people can ultimately afford.
Absolutely. So, because this is a fiscal consolidation we think taxes will go up. That will be a drag on growth. And that has real implications for people's earnings and for the size of the kind of economy that they can draw from. Probably, though, it's relatively muted given the tax levers we think might get pulled. You're looking at somewhere between 0.25%, maybe 0.4% of GDP spread over a few years. So in any given year, maybe just, small amount, 0.1%, maybe 0.2%. But perhaps more meaningfully, if the Chancellor's talking about policies such as cutting VAT on household energy bills, that could directly lower the cost of living for households. We think probably in our calculations that could take about 0.15 off of overall inflation. And again, that helps the Bank of England to lower interest rates, which feeds through, as Ben was saying earlier, into other rates in the economy, so households' mortgage rates, the rates that businesses can borrow at. So all of that is a fillip for the economy, even though it comes at this cost of a drag in terms of near-term growth.
I think there's two extra things I'd add. One is that the point Jack made about by making tough noises and signalling that the fiscal rules are here to stay and that she intends to do what's right for the country rather than whatever, I can't remember what her precise wording was, that has directly led, so far we think, into lower government borrowing costs. And it just goes to show that sometimes if you set out a credible plan ahead of time and maybe structures and frameworks around that, you can actually end up loosening your belt a little bit. It can actually make your life a little bit easier. You can meaningfully relax your constraints by making a sort of commitment ahead of time. And that's one purpose the fiscal rules serve. The second thing is, as Jack was alluding to, I don't think we can view this, the impact of this budget on people's livelihoods in isolation, because what the Chancellor seems to quite clearly have in mind is a world where she can potentially take targeted action on inflation, as Jack was suggesting, on VAT, on energy bills, but more generally give the Bank of England space to cut interest rates sooner, which feeds through into wider economic performance, households, balance sheets, and the rest of it. So I think there's some degree of not direct coordination going on, but you have to think about these things in the round, because it's not just about what the direct measures in the budget will do for people. It's about what the wider economic context will mean for their lives and their families. I think both matter.
Of course, the Bank of England will make its interest rate decision after the budget now, the next one. I think most people think that borrowing costs will come down. But we're not necessarily going to return to that nice world, or nice for some of his world, of really low interest rates that we all got used to for a while. So I suspect we're in an era of now actually, maybe not permanently, but higher borrowing costs for a while. We're not about to return to 0% interest rates, right, Jack?
No, I mean, look, we think there's probably a couple of more cuts in the kind of the pipeline. But I find it really interesting, if I think about this in a real economy, kind of people's actual daily lives, even with all the cuts in interest rates we've had in the last year or so, if you're coming off of a 5-year mortgage that you fixed 5 years ago, you are seeing more than a 2 percentage point increase in your interest rate on your mortgage.
And that's really painful for people.
And that genuinely, if you were already feeling kind of the cost of living and you're already on a pretty tight budget, to suddenly have to pay that is, that's a big shock to the system. So, that is just the different world that we live in now to we did in the kind of the period before the cost of living shock.
Yeah. And if you want to talk about what the structural factors are determining long-term interest rates, we might need a separate podcast and potentially a better guest than me. But I think that no one expects, at least in the short term, rates to go back down towards zero, right? That was a weird period. We may all look back at that as an anomalous period. And I think there's good reasons to suppose that the long-term trend is upwards anyway, or at least, not back down to zero.
And that matters for governments. Clearly, it matters for households, the way that Jack was describing. But for governments, I mentioned that the interest rate bill is now, it would be the second biggest department if it were a department. That's not going to go back to being a trivial bill anytime soon. We should get used to the idea that interest rate costs are high for the government, and therefore the government, in its own self-interest, should be thinking about the cost of borrowing because it's expensive.
Yeah. Sometimes the universe tells you to borrow more, and sometimes it tells you to borrow less. But unfortunately, our decision-making seems to lag conditions by about 5 or 6 or 7 years, and we tend to do all the borrowing at the wrong time.
And when you say universe, I mean, you could easily read financial markets into that, right?
Yeah, sometimes financial markets tell you to borrow more, and sometimes they don't.
Okay, so finally, before we wrap up, we've talked a lot about the economics, understandably, because we're economists. But there's also a big issue here about political uncertainty. So interestingly, when Rachel Reeves, back whenever it was, had a tearful moment in the House of Commons, markets moved. So markets are not just responding to kind of underlying fundamentals economics, they're responding to who they think is in power, who's setting fiscal policy, and what that means for what might happen. This matters, right, Ben?
Yeah, but I think that is, in some sense, responding to the fundamentals, or where people think the fundamentals would be, because people weren't, responding to that tearful moment because they were really worried about Rachel Reeves' emotional well-being. It was because they thought it was a signal that she might be replaced by someone who would borrow more and be less attached to fiscal prudence. It's that fundamental question of where do we think borrowing's going that matters here. And so, the one looming question over this budget perhaps is the Chancellor might well do, what she thinks is the right thing. She might do a big fiscal consolidation. She might do it through broad-based taxes, something like an income tax rise, in order to be confident in the revenue she's getting in and doing minimal economic damage in the process. And all that might well be sort of what bond market investors want to see in the short term. It does, there is a longer term question about who will be Chancellor in 2, 3, 4, 5, 6 years' time after the next election. And then clearly, if you're thinking about the long-term path for government borrowing and for the economy, that matters as well. And so inescapably, you have to think a bit about the politics here if you're trying to predict future paths for fiscal policy.
Yeah, and of course, what the Labour MPs, backbench MPs want isn't necessarily going to be perfectly well aligned with what the bond market investors want. But Jack, how important is this political uncertainty, do you think?
I mean, I think this is actually where all the points we've talked about across this kind of recording come together. This is about credibility. It's about the underlying fundamentals. And I think, across the spectrum of investors that I talk to on a daily basis, I think there is concern that actually, if you end up in a world where you're asking the market to absorb more because you've changed personnel, that would be seen as a very difficult place, and they would require a kind of a higher return to be able to do that. So I think this is a kind of a big unanswered question. Is we'll see on the 26th of November actually what the policies laid out are, but the question will be, okay, how credible are they to be delivered if we don't know if the Chancellor is going to be the one delivering them?
With that, let us wrap up this episode. Hopefully we've convinced you that government bonds or gilts are less complicated than they perhaps sound. In short, the government borrows money by selling bonds to investors, and those bonds basically pay out interest to investors for a set period of time. The more the government wants to borrow, so the higher the supply of bonds, and the lower the appetite for lending, so the lower demand for bonds, the lower the price and the higher the yield or the interest rate. And a lower price or a higher interest rate means it's more expensive for governments to borrow. And it is currently a relatively expensive time for the government to be borrowing. That's partly about a change in who buys government debts. We talked about fewer defined benefit pension schemes buying our government's debt. It's partly about more governments around the world selling their debt. And it's partly that the Bank of England is also selling more government debt at the moment. We are not, I think we all agree, in hock to the bond market. It is the Chancellor who sets fiscal policy. And we could borrow more. It's always just a question of how much it would cost to borrow more. And I think it's in the Chancellor's interest, in all of our interests, that she presents a credible package of fiscal measures at the budget, because we don't want to be paying more for our debt interest than we need to. We don't want to be paying a premium on that. And even small changes in borrowing costs can have significant effects on the public finances. So put bluntly, for this upcoming budget, if Rachel Reeves can reassure investors that she has a credible plan to ensure that tax revenues will be high enough to cover day-to-day spending in coming years, and a credible plan to ensure that debt doesn't keep rising, a credible plan to make sure that growth doesn't falter, then it will be less costly for the government to borrow than it otherwise would be, which would be good for all of us. But on that, thank you, Jack. Thank you, Ben. Thank you, all of you, to listening to the IFS Zooms In. If you enjoyed this episode, please do subscribe and share it with anyone who you think might be interested. And if you would like to support this podcast or our broader work, you can do so by becoming a member for as little as £10 a month. There's a link in the episode description. But for now, thank you again, and we'll see you next time.